M Finance, a key NBFC player, has planned to foray into life, health and general insurance. These plans being subject, of course, to approval from the insurance regulator. But moreover, Mahindra Finance has a very good hold on the rural finance space. To talk more about this, I'm joined now by Ramesh Iyer, MD and VC, Mahindra Finance, who's in our studios here in Mumbai at NDTV Profit. Welcome, first of all, Mr. Iyer. Great to have you here today.
Thank you.
Let me begin by getting your sense about the space that you are in, because a lot of questions now, while we see phenomenal GDP figures, we see great growth, is about whether rural India is catching up or is in the same space. What is your sense here?
So, last 4 or 5 quarters, if I look at, it's been a fantastic story out there. A lot of excitement. I think the sentiments are very positive. And typically rural, we look at 3 cash flows which add up to what's happening out there. One is the tourism. So we see how is the people movement. Second is we look at how is the crop cash flow behaving. So how has been the farm. The third is the infra story. If you look at all 3, I think rural has been doing extremely well. And then if you look at our own numbers, right, we've had phenomenal growth in terms of disbursements are concerned. And the real measurement from a rural perspective is how well is your collections doing, how is your delinquency, and all of that is doing pretty well for us. Yeah. And the gone by festival season was, I would think, one of the best.
Mr. Iyer, one factor that pulled down your bottom line in the second quarter was that GNPs had risen slightly by about 200 odd crores, resulting in nearly 100 crores of additional provisioning that you've done. And now, historically, we've seen the second half of the fiscal is usually quite good for the rural economy. You've mentioned how the Dussehra was amazing. Diwali has, I believe, kept its promise and actually been as good as the Dussehra, I'd like to believe. Will this help your GNPs come down below 4% in the next couple of quarters? And I'm not expecting a forward-looking statement, but just to get a sense from in terms of the outlook.
So let me first even put out on the first half went by. Never before historically was our GNPA lower than March.
You're right.
And this was the first time that we saw that in the first half of the year, the GNPA number was lower than even March.
Yeah.
So that's a good news for us. If you look at our collection efficiency, which has been putting out every month, has been upward of 92, 94 plus. And therefore, if you look at the second half, which is the best always, and I think the monsoons have ended up well. The sentiments are positive. We just talked about the festival sentiments. We talked about the infrastructure that's happening out there, the roads, so the labor and the assets that are getting deployed. So I don't think we have any reasons to worry about or to believe that the second half would be as good as we have always seen in the past.
But it will be better.
Yeah, it will be.
Okay.
But did your tractor write-offs not increase, at least, in Q2? Are you seeing any kind of a pain over there, or are you seeing a complete revival?
I think, we should always differentiate between GS3 and an eventual write-off. Our GS3 numbers always used to be a little higher because of the cash flows of the rural market. But you look at our credit write-offs, it's never been more than 1.5%. So these customers, though delay, don't default eventually. They pay in an extra time that they want, and as the cash flow improves, they pay off. So let me give you one quick example. During the COVID second wave, in the first quarter, our gross NPA, that is stage 3, went up to 15%, right? As the market started opening up, people come back to work, we saw it climb down now to as low as below 4%. So these people don't not pay, while they may delay because of their cash flow.
What does that mean for provisioning then? Because that was elevated again, we've seen. Is this a conscious business decision that you've taken? Is it part of some strategy? Or, and also any specific areas you're providing more for now?
No, so clearly look at the customer segment that we work with. They're all earn and pay segment.
Correct.
Right? So
and
they acquire this asset. So when they acquire this asset, it is to earn from that and pay. And unfortunately, when the assets are not put to use, there's no point in pressurizing the consumer to pay, right? Where will they bring the cash flow from? So therefore, consciously, we have taken the decision to partner with these customers even during their difficult times. I think in this business, what's more important to really understand and really learn from is what's the difference between circumstantial and intentional defaulters. And if they are circumstantial defaulters, that's a model that we have got into.
You've already priced that in any way.
Exactly, and therefore if they are intentional defaulter and if you have made a credit judgment error, don't delay the decision.
How would you though know about intent? How would you decide for that? What's the filter for that? Because
that's a model, right?
That seems like a bit of a discretionary call at the end of the day. Or
that's a model, right?
Okay.
We have 1,300 branches. We have 10,000 people on the street. There are people who've been locally recruited, and therefore they have a phenomenal connect with the consumer base there, one. Two, we know what works there in the sense which asset is put to use and what's the earning from these assets. So if I have lent to you on a vehicle and I see your vehicle being used, and if you're not repaying, I don't have to double guess, right? I would put it in a category of intention not to repay. Right, but if you were to come back and tell me that, oh, I took this asset from you, this is the reason I took it, I have lost this business, and therefore my asset is not in use, I would rather take back the asset and transact and give it to someone else for a better use. So I think the local connect is super important as far as we are concerned, and understanding of where the assets are deployed. And we have many customers in the same use.
So it's all referral, especially this rural business is backed by referrals largely, right? Family, extension,
business, local knowledge, speak the local language.
Very different
so it's a model which is very homegrown locally to suit these requirements.
Now I want to, Mr. Iyer, just move the conversation a little bit and talk to you about your NIMs. The current outlook on the rate cycle is such that we should be hopefully getting a rate cut over the next 6-month period. Of course, it's been delayed from what businesses were initially anticipating. What is that doing to your borrowing cost, and what are you penciling in? Because I know your NIMs were pressurized slightly because you all hadn't moved, hoping that cost of borrowing would come off. That hasn't happened, but now we still have some visibility on that. Are you working on it? What are you going to do? Is there sort of changes that we can expect, or status quo, and then the impact of that on your NIMs?
So clearly, we were also expecting the rates would come down, and I'm on record to say that we thought around festival time one would start seeing the rate cut, but that didn't happen. And we delayed our decision to obviously increase the lending rate. And we didn't want to do it, obviously, at a time of the festival. The sentiment was so positive, why spoil it? And therefore we delayed it. We've already increased our rates across the board for all products by about 20-25 basis points. This is something we will definitely get benefit of. I think the other way to look at the NIMs really is to look at the product mix change. Right? If you do more of pre-owned vehicle, then your yields are better, your NIM starts to improve. So that's one of the strategies that we put in place.
And how much does pre-owned vehicles contribute to your top line?
So currently it's about 15%. We do believe it can go up to 20-25% of the total.
Over the next couple of quarters?
Oh yeah, clearly, at least for next 3 quarters. That's the direction in which we are.
And what is the increase in yield that you get there? So I want to get a sense of what that means for your top line margin.
So I think the yield difference between a new and a pre-owned vehicle is at least about 3-4%.
Oh wow, okay.
Yes, right. And therefore, if you do increase your pre-owned vehicle, you get the benefit of it.
So blended margins, expectation in the next couple of quarters?
So we were on record saying that our NIMs had come down to 6.6. I think the first step is to go to 6.8, but then move to 7.1 is what we're looking at in the next couple of quarters.
I just want to get a sense from you on your personal loan book. Because and whether you are doing smaller amounts or smaller ticket size of loans, simply because it is an area of concern in a different context that the RBI has pointed out to. Are you seeing that trend in the rural segment business, or if you can add more color to that?
So need for personal loan is very high. I don't think we can move away from that reality. Even in rural India, when we talk to people, they do need personal loans, and for right reasons. Maybe there's some wedding in the family, health requirements, education to children, all of that contributes to this personal loan requirement. We've consciously stayed away from personal loan in rural because we are still were in a physically touch model, and therefore you lend the small ticket loans, recovery cost is very, very high, right? And that's the reason we are not in two-wheeler business as well in a big way. But what we've done, though, to get into this business over a period of time is to start lending to our existing customers who've repaid extremely well. So we're looking at customers who have repaid our personal loans for the last 12 months. Therefore, we have their credit history, 1. 2, we at least have another 2 years of loan going for the vehicle, in which case we are still in touch with the customer. And therefore, if these consumers want a smaller loan, then we are willing to provide this loan, and it's in a way collateralized by the underlying asset.
So when you're saying you're seeing an increase in demand for personal loans, can you quantify that, the kind of jump that you're seeing, or are your existing customers coming in larger numbers?
So I may not have a clear number, but then if you kind of do the CIBIL scrub of many of these customers or customers from that market, you'll find that they are all borrowing from some source or the other for their personal requirement. Now, it's also a good news in some way, in the sense that if someone was not to provide formally, probably they will be going to a money lender or a trader.
I was going to come just to that point.
Which is a much higher cost, right?
Yeah.
And therefore, one needs to look at it as, is there a need for such a loan? And therefore, is the need being correctly met? Then I think it's a great format. But it should not be for a situation that, oh, somebody is giving me a loan, let me take it and see what I'm going to do with it. Right? You shouldn't reverse the order. There should be a purpose for which you take a loan, then I think you're replacing it very well. But if you say, no, I'm going to provide you a loan, think what you want to do with the money I'm providing, is not a great story.
Mr. Iyer, I want to talk to you about the co-lending deal with SBI that took place a few weeks ago. How is that coming along, and what does it also mean for the SME part of the business? And also, if there are any more co-lending deals that we should be watching out for?
So I think it's early days while we've signed up, but we see a lot of consumers come to us and they're requiring 5-year, 7-year loan. Maybe they require a low-rate loan. No, we, as an NBFC, we don't source 7-year, 10-year money to be able to run that.
Cost of borrowing again
and
gets
we want
off.
to be very clear that we don't run ALM mismatches, right? And therefore, it's a great product working with someone like SBI to offer these kind of loans to maybe fleet operators, maybe to SME, and we would see good traction in that going forward. That's for sure. In as far as more deals like this, I think we are very open to be able to work with many such formats. Because it has to add value to the customer at the end of the day. It can't be that the two of us who sign up will be benefited, the customer has to benefit.
In this deal, how much of this are you going to be a beneficiary of? And again, what will that contribute to your top line, these long tenure loans?
It's a small number at this stage because only 20% of the book will be with us, 80% of the book will go to SBI. And therefore, this will be for such consumers whom otherwise we would not have been able to lend to.
So it's anyway an opportunity, right?
It's an opportunity, and therefore there will be some add-up, but not a strategically large book at this stage.
One quick question, Mr. Iyer, and this is what I think Taman and me have been seeing and talking about pretty much every day with fundraising. Everyone and anyone is out in the market for capital fundraising. Is that on the horizon? Are you looking to raise any funds? You've talked about doubling your asset book by 2025. Can we expect any sort of capital raising exercise?
No, so if you kind of look at our capital adequacy, Tier 1, Tier 2 together is upward of 20%. Tier 1 is upward of 17-18%. So I don't think we need to raise capital in an urgency. Plus we are making sufficient profit which gets added to the net worth. So for the growth story that we are talking of go up to 2025, we don't see that happen.
Talking about that growth story, news recently about larger foray into the insurance space. Can you add any details on that, what the outlook is there, especially considering the policy push right now for an increased penetration of insurance in rural India as well? How do you see that developing, and how excited are you about that?
So we are very excited, otherwise we wouldn't be going in for this. I think clearly we have a broking license, and therefore we were distributing insurance of various insurance companies, both in life as well as health and assets. What we see is getting into an agency makes it even better for customers, because as a broking you can only have so much reach. Through an agency with Mahindra Finance's 1,300 branches, can we go more deeper and offer more product? And as an agent, we can work with at least 5-6 insurance companies and offer this product. So clearly what we are now getting into is an agency. To a broader question of our interest in insurance, I think that's a very, very interesting space for us. We are not yet there in terms of insurance manufacturing, but will we look at that space? I think we've been looking at that space very closely. And as we see that open up for us as an opportunity, we won't miss that.
It's also a space that has a lot of government support or thrust towards insurance for rural economy. But thank you, Mr. Iyer. It's such a pleasure to have you in the studios, understand what Mahindra Finance is doing. Very clearly, lending with a heart is probably the best tagline for them.